Hey there, it's Mitch Goldberg. Thank you for joining me. You are watching Be the Boss of Your Money. This is my live stream about the stock market, about investing, about borrowing. It's all about personal finance. And I thank you so much for joining me. Your time is valuable, and I really appreciate that you chose to spend some of it with me. We've got a few big stories today. I was off yesterday. I had moved my stuff back to my office, getting set up. It took me a good amount of time, new setup. It means a lot of new cables are going to be purchased over the very near term. That's the problem. When you move your gear around, you realize that the cables need to be changed. Yes, that is an important thing. Different size cables. If you have the wrong size cables, it's just mayhem with wire management all over the place. But anyway, GE catches an upgrade. Morgan Stanley just dramatically increases their capital return program to shareholders, which is expected from all the major financial institutions in America. So a lot of good things to talk about, but what's the deal with the 10-year treasury and what happened? It's kind of weird. We were so bullish of the market, even though the market's hitting new highs. I feel like this is a record run in the S&P and NASDAQ that investors just seem to love to hate. Is that because we're at the end of the stimulus road and some investors maybe want to consider jumping off? If you look at the 10-year treasury, I think you'd have to actually agree with that. So we're going to roll the quick intro. I've got a couple of things to go into, and this is going to be a good show. I'm pretty excited to be broadcasting to you from the original place where it all started, from my real office. Okay, here we go. Okay, thank you so much for joining me. If you're just tuning in now, I'm Mitch Goldberg. You're watching my live stream about personal finance. It's called Be the Boss of Your Money. Got a couple of things to talk about. GE catches an upgrade. S&P. Oh, so many things to go through. I was out yesterday. So no show yesterday. And excuse me, just allergies today. I just feel like we have a lot to catch up on. But if you have any questions, you know the deal. I love hearing from you. So go right ahead and ask me in the ask me in the comments. I love to hear from you. Any questions you have about what we're talking about today, or what we've talked about in the past, or what you think we should be talking about, hit me up. I love the questions, and that's actually the most fun. And let me know how I'm coming into you. So I reset up everything. And the amount of cables and wires all over the place, it's really like a minor miracle that I got it up as quick as I did. And in one piece, nothing broke. I will be getting that new computer I've been talking to you guys about. I actually got it already. It's in the hands of my IT company. Plus, I got a new 38-inch curved screen in 3K, and I should have that tomorrow. So I can't wait to put the new gear to the test. Should make for better streams. And for my streams right now, they black out sometimes, very intermittently. But when it happens, it's very upsetting to me. And that is basically because my computer can't handle the capacity of the streaming. It just wasn't made for that. So anyway, let's get into today's topics. Let's see how the camera switching goes. All right, I'm on camera 2. You can see me right there. So first thing I'm going to do is we're going to talk about, what are we going to talk about? The S&P, again, hit a new high today, and this is the fourth record close. Did you know that today? This is the fourth record close in a row. NASDAQ also hit a new record high. For the S&P, the month ends tomorrow. I can't believe June is already over. June 2021 is over. But right now, the S&P is up for the last 5 months in a row, including June. And the NASDAQ is up 7 out of the last 8 months. So the bull market continues. And we've had a lot of reasons to think the bull market will end. A lot of people have made changes. We call them adjustments to their portfolios. Unfortunately, timing the market is very difficult because the market keeps hitting new highs. So that's one thing to consider. The other couple of things we need to take a look at is the Delta variant. So the Delta variant is now becoming it's almost become the most, not quite there yet, the most prevalent variant of COVID. The good news is that the vaccines developed in the United States are very effective. They continue to be very effective against the new COVID variants. And Moderna, in a test today, says that their vaccine effectiveness could last for years. There are also studies that say if you mix and match different vaccines, you could get even better and stronger results. We have a lot of good things to look forward to. The economy continues to reopen. You know that. But that doesn't mean everything is good for the market, and it doesn't mean everything is great for your net worth, okay? But we're talking, as far as personal finance goes, listen, don't use this time of easier to find a new job and easier, and things are getting back on track in the economy. So the economy is doing very well because of pent-up demand. But you have to think to the next cycle, to the next slowdown. What I would tell anybody is take advantage of this time that we have now to learn new skills, seek higher education. It doesn't mean you have to spend a fortune, but find certificate classes or something that demonstrates that you looked for opportunities for higher education, for advanced training, job training. Take advantage of this time we have. This is a good time to find a job, and there's a lot of job security right now. But don't waste the time, because we will have another down cycle, and you'll wish you would either save more money or learn new skills. And people go through that every time there's a down cycle. So don't let this go to waste. 2020 taught us anything. 2020, we got a lot of government stimulus for all things, including housing, unemployment. And a lot of people got through it, kind of shell-shocked the first few months, but we're coming out of it. Don't you use this time well. Somebody said to me, a friend of mine said to me, Mitch, I'm so busy that I'm not creating any more content. And what's the point of being busy with content if I'm busy with work? And I get that. I totally get that. But the reason you want to be busy right now creating content, from my point of view, is for the down cycle. I'm super busy too. I'm in the stock market. I'm a financial advisor. Things are very busy. Clients have a ton of questions, lots of planning going on. Lots of clients are actually retiring ahead of time because their stock portfolios and the value of their home have gone up so much that they're years ahead of where they thought they would be. So they're like, hey, forget it. I'm calling it quits. I'm out of here. And people are retiring even earlier than they thought, who are my clients. But anyway, the point is, I'm going to continue to create content, because you might not think you need to create content in good times, but it's kind of like this. You create content in good times because the cycle turns. You want to create the content, build the brand recognition, showcase your expertise, and become a known entity now, so that you have that during the next downturn. Okay, it's called brand equity. You want to deposit as much brand equity into your brand equity bank, because one day you're going to be making withdrawals on that. So don't stop. It's kind of like networking. When is the best time for business networking? When times are good. Because if you wait till you're laid off from a job and the economy goes into a deep recession, and that's when you're going to start networking, it's already too late. The idea is to network before you need a job, before you need to replace business, so that you are ready to land somewhere when the stuff hits the fan. Okay, so that's my little rule of life that I hope to impart on some of you. Okay, I know some people are out there watching this, so just say hello. Let me know where you're watching from. I always enjoy that, and I love hearing from you. So if you have any questions, let me know. Okay, a couple of other things to go through. Even though the market's been hitting high after high after high, we had that down week a few weeks ago where the Federal Reserve met, and they pulled in a little closer their timeline of tightening, of slowing down their bond purchases every month and getting a little bit closer to raising interest rates. Well, that sent the market into a tizzy. The market went down, and then the market came back up the next week because it was soothing. It turned out that once investors came back around and realized that the Fed is actually cognizant of inflation, that they're worried about it, that they're watching it. I don't know. I don't want to say worried, but they are concerned. They're just very aware of it. That actually soothed investors' nerves and brought investors back to the table. So the down markets recovered, and then they made up for some and hit new highs. But the highs that are coming now are very incremental, fractional highs. Why is that? Is something happening? I do see breadth getting worse. I see fewer and fewer stocks participating in the upside. So are we heading into, summer doldrums? Next week is, July 4th week. It's a really quiet time in the market. Very, very quiet time around July 4th. Then it'll pick up until, let's say, the second week of August, and then it's kind of doldrums until we come back after Labor Day. But I think the real concern is, look, the market could keep drifting higher. And there's an old expression, never short a dull market. But the market could also correct. Look, the market could do anything, and I'm not really worried about what it's going to do over the next month or two. I'm looking at much longer than that. I look in terms of years, in terms of decades. But we are looking at things now, and if we want to know, is there a regime change in terms of inflation? Because with inflation at our backs for so long, lower inflation and decreasing inflation, how would it be if we had increasing inflation in front of us as a headwind that lasted not just for a few months, but for 10 years or so? There's just a lot of unknowns. And if you're waiting for the unknowns to clear up, by the way, you'll never invest. Investing is about finding companies who could innovate through thick and thin, and they plow ahead. We've got a few of those now. It's called Alphabet, Google, right? Google. If you didn't know, Google is not called Alphabet, and Google is just a division of Alphabet. Google is a search engine, which is like 90% of the company, 92% of the company. There's Facebook, which hit a new all-time high yesterday. Look, I remember Facebook was like 265, and people worried about a Justice Department investigation, maybe breaking it up. Now the Justice Department dropped their case against Facebook, and the stock is about 350. That's like a $26 stock going to 35. That's a pretty good move in a matter of 6 months, 8 months. So that's a pretty good gosh darn move. Okay. So we have the summer doldrums coming up. It doesn't mean the market can't go up or down a lot, but I think when the volume is so low and we're in the summer doldrums, it does mean that moves could be very exaggerated to the upside or to the downside. Okay. So what else? Let's talk about bank stocks. So we had the stress test. They finished, last week. The Federal Reserve announced its results for the stress test. 23 financial institutions, they all passed the stress test with flying colors, including banks like Citigroup and Wells Fargo, which have the last few years have had trouble with stress tests. And now they're all in great shape. And what we're expecting is a surge in buybacks, dividend increases. Today, we got a big announcement from Morgan Stanley. We expect more coming from others. And these are gigantic buybacks. I mean, we're going to get, hundreds of billions of dollars worth of buybacks from bank stocks, in bank, buyback announcements coming up, and lots and lots of dividend increases. And don't think that because a bank increases its dividend, that's it forever. They will probably make more than one dividend increase over the next year or two. So when investors are searching for income, for quality, for companies with great balance sheets, it really does look like bank stocks are the place to be for that, in spite of the fact that the bank stock sector overall did pretty poorly today. And it's been going down for a while. So let's take a look at something. And I think there's two main key points that we should take a look at. Okay. First of all, I just want to mention GE catches and upgrades. I'm going to do a quick share screen with you, put myself up in the top over here. Hey, everybody, I'm up in the corner over here. I'm going to make this a little bigger so you could all see it. Okay. GE up 20 cents today. It's up like another penny in aftermarket trading. I just saw a few minutes ago, but they caught an upgrade, and Goldman Sachs says, hey, GE is early phase reopening play, improving fundamentals for an industrial company. And that jives with what I've been saying about GE and Ford and a company called Wabash National for a while, that some of these low priced stocks are well into their turnaround. Wabash, you might not be familiar with it, but they make trailers for tractor trailers, and their logo is a red map of the United States. And on the back of like almost every tractor trailer you see going down the road, you'll see Wabash on the back of it. And if you haven't heard of Wabash, now that I mentioned Wabash to you, you're going to start seeing it like everywhere you look, and you're going to be like, how did I not notice that? Because it's so ubiquitous. It's like almost too obvious, right? Let's take a look at U.S. markets today. So the Dow was up a measly 9 points after being up over 100. NASDAQ up 27. S&P up 1 point. These are very fractional moves. I mean, NASDAQ up 19 hundredths of a percent. S&P 3 bips. That's nothing. Gold backing off a little. Oil continues to hold up, but the 10-year Treasury. So I want to highlight the 10-year Treasury. Okay, and I want to highlight gold. These inflation indicators are indicating, I think they're indicating deflation, if you ask me. I don't think they're indicating inflation at all. Because with the economy going up, what's going on here? Well, first of all, you have the Fed who came out and said, we will tamp down inflation and do what we need to do to make sure that inflation doesn't get out of hand. We want to wait as long as possible until there's more equity in the labor market. That's what Jerome Powell says. But we will do what we have to do. And I think that took away from the tone-deaf appearance that the Fed had in regards to inflation. Gold is not going up. I mean, gold keeps going down, and that's supposed to be an inflation hedge also. Not that bonds are an inflation hedge, but the yield should be going up, not down, if you think inflation is on the way. So yields continue to stay low. The VIX continues down here, continues to stay at around 16. And I will just show you one more thing here. The Russell 2000, that was off 0.5%. And when the Russell 2000 off 13 points, off 0.5%, okay, almost 0.6%. That is not a great indicator. That, small cap stocks are very economically sensitive, more so than large cap stocks. They get more of their earnings and revenues domestically as well. So when the Russell 2000 goes down more than the other averages, I think that tells you a little bit more that investors are worried about a slowdown in the economy. Investors are looking at the next cycle. And that's why you're seeing the 10-year Treasury yield stay low and go lower. You're seeing gold going lower. Consumer confidence hit a very high level, higher than expected. But we typically get a jump in consumer confidence toward the end of a cycle, not the beginning of a cycle. That's a late indicator, lagging indicator, I should say. So I beg to differ with a lot of things that people are talking about. And now let's talk about the stimulus plan. All right, so we might have a stimulus plan. Okay, we might get it. And the stimulus plan could be, maybe around $1 trillion, but it's not a law yet. Okay, it hasn't come to pass yet. It might not. There are so many things that could go wrong between now and when we get an infrastructure plan. It's a $1 trillion plan, a lot less than what we were talking about in the beginning of the year. People were talking about a $2.5 trillion plan, $2.3 trillion plan. But I think what investors are going to start talking about is that it? Like, are we at the end of the stimulus road? Like, once we get this, what do we have to look forward to? Are we going to get another stimulus plan? I know that the Dems are trying to squeeze in a plan using reconciliation, a party line vote to squeeze through some more stimulus. I don't think they get it. Look, I don't want to make predictions and promises that I can't keep, but I do think that investors have to take a good hard look in terms of, is this it? The stimulus package, is this the end of the road? And from what I'm seeing from Treasury yields going down, gold going down, small cap stocks doing a little bit worse than large cap stocks, and economic indicators, while they're very, very good, this kind of strength in some of these economic indicators are typical of end of cycle times. It's a concern, and I think that's why you're starting to see the up market, the record-setting rally starting to be set by fewer and fewer stocks, by smaller and smaller increments. So is this a summer doldrum? Are we going to go into a pause that refreshes? Or do we have to acknowledge that, between the end of stimulus programs coming out and the Fed getting to its own end of monetary stimulus in terms of bond buying and ultra low interest rates, it's going to be a deep breath moment when the economy could finally run on its own. I mean, a lot of us are saying that. A lot of us are saying, the economy should be able to run. The economy should be able to run on its own. So, if a lot of people saying that, it's one thing to believe it. It's another thing to have faith in that decision, because when you get right down to it, now you have to live with it, right? It's like your beer muscles, right? Everyone's bold and brave, but when it comes down to getting into that fisticuffs, now you really have to be brave and have confidence in what you believed about yourself. So that's what's going on with the market. I want to see if there's anything else I left out. Let's just do a quick thing here on Boeing. Okay. That's not what I want to do. Boeing. Okay. So United Airlines, United Continental is buying 270 Boeing and Airbus jets. It's the largest ever order for a post-COVID growth plan. That is a huge order for Boeing. They're buying MAX jets. From Boeing, they're buying 70 Airbus planes. I've been on Airbus. I haven't been on the new Airbus, but I do like the Airbus planes. That's what JetBlue uses, and I'm pretty happy with those. So, but Boeing stock was barely up. I think the stock was up maybe. Was it up? I think maybe 14 cents. Maybe. Let's take a look at how Boeing did today. All right, it was down. It was down $4 today, up 14 cents in the aftermarket. Big deal. So Boeing was down, in spite of that really big order. And so that's, I don't want to say it's overly concerning. We have to see if they get some orders from Chinese airline carriers. So we'll see what happens. And let's take a quick look at Leon Cooperman made a good point today. Leon Cooperman plans to stock pick his way to success, not expecting much more from the overall market. And that kind of goes hand in hand with what I've been saying, that if everyone thinks they're smart in a bull market because everything's going up. But if not everything's going up, then you have to really become a good stock picker and you have to become a real investor. Now, it doesn't mean that all of your investments have to go up to be a real investor. Real investors, good investors know that investing isn't going to be good every day. It's a game of patience. Like you want everyone else to blink, and you don't blink, right? Everyone will sell out. Maybe your stocks will go down, but eventually they come back and they go up. That's what investing is, right? There's a level of conviction, of research, of belief that you are doing the right thing, and you do it in a diversified way, so that if the things or the stocks you're betting on, if they don't work, you have others you could fall back on. Diversification is a strategy that we use to mitigate risk, but it doesn't necessarily protect your portfolio from a generally down market. Okay, so that's what Leon Cooperman says. So it kind of goes hand in hand with what we've been talking about, that we really are going to have, I think, a tougher time relying on just the averages generally going up. And we're going to have to start to rely on individual stocks as opposed to just being in the right sector. Okay, a lot of don't ever mistake brains for a bull market is the old expression. Okay, so let's pop myself up here again. Let's go into another screen. So that was Boeing, Leon Cooperman, and let's just take a look at some crypto. Crypto's been having a big day. I mean, everyone's so it's the end of the world for crypto last weekend. Come back in this week, and all of a sudden, crypto is moving up again. Even Dogecoin is up a little. The Doge, it's up 3%, 26.5 cents. I don't know. Do you think it's worth taking a shot on Doge? It's Elon Musk touts it, then he says meh, and then it goes down again. I can't stand when he does that. I think that is so wrong to do. And then we've got the industrials. We took a look at GE, but let's just take a look at the financials. Then I'm going to let you go. Okay, Morgan Stanley had a really good day because of their capital return. Forget Coinbase. Goldman Sachs is expected to return value to shareholders, and all of them in the form of rising dividends and stock buyback. So they had a weak day today, the bank sector, but they are getting to a point where it's good that there's some downside in them, because I do think this is a group that will at least have a story behind it if all else fails. It would be nicer if long-term rates were going up so these companies could make more money on their net interest margins. That would be a way to make money on real earnings generation, as opposed to what's the word? As opposed to financial engineering. Stock buybacks and dividend increases is financial engineering, but I'd rather these banks go up because they're actually making real money. They're making real money, but even more money because they have a better profit from better net interest margins. That means the difference between what their cost of capital is and what they lend money to, what they lend money for, which is your cost of capital. All right, that's about it. I'm going to wrap it up now. I'll see you tomorrow. Thank you so much for joining me.